Now let's talk about one other big change in tax rates here that will affect almost every person watching this that earns some type of dividend income or capital gains from selling investments or other types of property. And that is the new capital gains tax rates for 2026. Now, if you don't know, a capital gain occurs when you sell an asset for more than what you purchased it for. For example, if you bought a stock for $10 and later sold it for 15, you would have a $5 capital gain. And it is very important for everyone to know how their capital gains will be taxed starting in 2026. So let's break this down. First and foremost, if you have a short-term capital gain, meaning that you held that asset for less than 1 year before you sold it, then that gain will be taxed at the same ordinary income tax rates that we just discussed, ranging from 0 to 37%. So you would benefit from being able to report about 3% more income at lower tax rates, but you would not benefit from the more favorable rates for capital gains, which exist for long-term capital gains. These are gains on assets you sold that you held for more than 1 year, which are taxed at rates as low as 0 to 20%. With that said, now let's address the new adjustments in terms of how those gains will be taxed in 2026. So for taxpayers filing single, you will pay a 0% tax on long-term capital gains if your taxable income is less than $50,000, a 15% tax if your taxable income is below $307,000, and a 20% tax if your taxable income is above that amount. And for married taxpayers, you will pay a 0% tax on your long-term gains when your income is less than $99,000. Just hold on for a second here. I just want to mention that this is huge, especially for retirees and people with less income. Because if your taxable income after deductions is less than about $100,000, your long-term capital gains would effectively be tax-free. So someone who has saved and invested diligently over many years may be able to trigger long-term capital gains at a 0% tax rate. And remember, taxable income is income you report after taking all of your deductions. So even if you earn above this range, you may still qualify if you're taking advantage of deductions like the standard deduction, the itemized deduction, or the hundreds of other business or real estate deductions that you can use to reduce your taxable income to or below this range. But moving on from that, once your income is above $99,000 as a married taxpayer, your long-term capital gains will be taxed at 15% and then taxed at 20% once your taxable income exceeds $614,000.